All right, everybody has had their lunch, is rejuvenated for an afternoon of innovative discussion of innovation. This panel is on experimental strategies for regulating fintech. I'm so excited to introduce this panel. I first encountered Hillary Allen's work when I was trying to understand the intellectual history of the concept of financial stability. And her work is some of the most thoughtful and deepest analysis of the history of that concept and how it's operationalized across jurisdictions. Then it turns out that she also has written great stuff on regulatory sandboxes that Christopher and I used in our innovation seminar last time around, and that Tom and I have used in our class on regulating fintech. This paper marries the two topics together and is going to share some new insights about how financial regulators might grapple with the good and the ill of some of the most cutting-edge innovations in the financial space, including smart contracts and robo-advisors. So we're lucky to have Tom Baker, who is one of the Legal Academy's, perhaps the leading scholar of robo-advisors, and also brings a sociological approach to understanding risk that I think deepens the discussion on innovation. So without further ado, here's Hillary.
So, don't applaud yet, you haven't heard it yet. So thank you so much for such a kind introduction, David. And I recently found out that my great-grandfather graduated from Penn with a chemical engineering degree. So it's very exciting to be here. I assume he would be proud. All right, so this paper starts with some themes that are really germane to a lot of the discussion today, and I'm glad we had lunch because we were all hungry, but in a way I'm sad that we didn't go straight from the last panel into this one, because so much of what Gus talked about is sort of picked up and operationalized on this paper, so I think there's a lot of nice synergies there. And in fact, the paper itself starts with some general discussion of the administrative law theory on dealing with innovation. So issues like resource disparities between regulators and industries, the time lag between private sector innovation and regulatory responses, opportunities for regulatory arbitrage, political economy issues of capture, and a desire by regulators to sometimes not interfere with market forces. All of these pertain to the regulation of any new technology, including fintech. So what I've done in this paper is I've selected 3 fintech business models to use as case studies to show how new technologies can confound existing regulatory regimes. I've also chosen to focus on 4 financial regulators, the SEC, CFPB, CFTC, and OCC, who will need to cope with these new technologies. So I used the case studies of marketplace lending and robo-advisory to focus on the challenges of regulating machine learning algorithms. And I used the case study of smart contract swaps to focus on the challenges of regulating smart contracts. Now, I know that's a mouthful. There are a lot, I could spend this whole presentation talking on background for those technologies. I'm not going to go into too much detail. Happy to tease it out more in the Q&A. But what I'm going to tease out for the purposes of this presentation is sort of what machine learning is and how that's a problem for regulatory strategies, and ditto for smart contracts. So the short version of machine learning is that it is a form of quote-unquote artificial intelligence that works by drawing patterns and correlations from large data sets. These machine learning algorithms learn probabilistically, meaning that they can't infer causation, and their decisions are likely to be unpredictable and inexplicable when confronted with low probability events. So machine learning algorithms can be used to rate borrowers' creditworthiness and to price their loans. They can also be used to assess an investor's desired risk profile for investments and select and rebalance investment portfolios for those investors. There's been significant concern expressed about the possibilities for discrimination by these machine learning algorithms, particularly in the provision of credit. The CFPB has jurisdiction over marketplace lenders and will have to rethink the way it supervises and enforces compliance with laws like ECOA, the Equal Credit Opportunity Act, as machine learning becomes increasingly integral to credit assessment. Less attention has been paid to my own particular hobby horse, which David mentioned, which is financial stability. Although some attention has been paid by Tom Baker and others, that if you have a situation where algorithms are selecting portfolios for massive numbers of people, that could entrench correlation in the financial system, exacerbating tendencies towards asset bubbles and also towards panics. If you think about if machine learning algorithms are programmed to rebalance portfolios automatically, that could result in a massive dump of assets, which could be problematic for the entire financial system. Algorithms could also misprice loans, and that in the credit allocation space, and so that could be another way of creating bubbles. And this is something that the OCC is going to have to grapple with, particularly if it becomes a primary regulator for the marketplace lending firms, which it does have aspirations to do through its Fintech charter, which I'll talk about shortly. But even if it doesn't become the primary regulator of the marketplace lending firms, which are not banks and therefore not typically regulated by the OCC, I can't imagine that the banks themselves won't start to use some of these algorithmic strategies for rating borrowers for things like mortgages. So this is something that the OCC is going to have to engage with. If we turn to the robo-advisory, there the business model is under the jurisdiction of the SEC. The SEC has typically not wanted to play much of a role in terms of looking at the stability of the financial system, but it's going to be overseeing a robo-advisory industry that could have significant systemic ramifications. This is something that I argue that the SEC should collaborate on with the other FSOC members. The FSOC is the Financial Stability Oversight Council. It's a group of all the financial regulators. They have been making a lot of noises lately about how they're shifting towards activities-based regulation rather than regulating entities. This may just be noise, but if they are going to put their money where their mouth is, this is something that they really need to be paying attention to, the correlation that comes from using machine learning algorithms. And also the SEC's more typical investor protection function will also be undermined by the use of machine learning if those algorithms learn predatory behavior. And there's a lot of discussion about machine learning algorithms learning from conflicted human advisors. Okay, so now I'm going to segue from machine learning to smart contracts. Smart contracts are basically contracts embodied in a computer program. They're intended to be self-executing and self-enforcing, although it's questionable whether they always are. Smart contracts are recorded and transferred on what's known as a distributed ledger, which you might have heard in the context of Bitcoin, but it has broader applications beyond Bitcoin. It's an electronic record that is updated in real time and intended to be maintained on geographically dispersed servers or nodes. So when I'm describing this in class, I just say it's kind of like a gigantic database that's hosted on a lot of computers, and it tells you who owns every asset and the history of who has ever owned every asset recorded on that ledger. ISDA, which is the International Swaps and Derivatives Association, has been very interested lately, making a lot of noises about representing swaps as the type of derivative contract as smart contracts. So swaps, perhaps most notoriously the credit default swap, combusted in the financial crisis, and so we had the Dodd-Frank legislation that was enacted in 2010 that had a whole new regime for swaps regulation, Title VII, and that is overseen primarily by the CFTC, the Commodity Futures Trading Commission. There are going to be all types of new operational risks associated with smart contracts with swaps if they're represented as smart contracts that are not contemplated by Title VII. Title VII is primarily about requiring swaps to be cleared through through central counterparties, and requiring the posting of collateral to ensure that parties are able to sort of honor their obligations under those swap contracts. Even when they're working well, though, not just when there are operational problems, I think using smart contracts for swaps adds new fragilities to the system by speeding up their execution in a way that precludes the exercise of human judgment. So I use several examples in the paper where I demonstrate that it would be in everyone's best interest not to always automatically enforce collateral posting requirements under swaps. But smart contracts take away that possibility. So the CFTC needs to engage with these new concerns and fragilities. Okay, so that's sort of my setting up the problem part of the paper. The next part of the paper is largely descriptive, and what it does is it outlines the high-profile regulatory experiments that have been taken so far by the SEC, CFTC, CFPB, and OCC in responding to the rise of fintech. And I also do talk about the United Kingdom's Financial Conduct Authority because it really has been the leader in financial regulatory experimentation over the last 5 years. So we already have had some allusion today to the regulatory sandbox. That was an innovation by the UK's Financial Conduct Authority in 2016. They adopted this regulatory sandbox, and then this as a regulatory model has spread like wildfire around the world ever since. The short version of what a regulatory sandbox is that it is something that allows firms to apply to regulators to participate in a regulator-operated sandbox that will allow them to receive regulatory guidance and also to test their product with real customers in an environment with less regulation and less risk of enforcement. The US has generally lagged in sandbox implementation. There have been a few states that have adopted them. The CFPB is the only federal agency to have adopted a regulatory sandbox. But I've argued elsewhere that I don't think this is necessarily a bad thing, that we're lagging in adopting regulatory sandboxes. I think people who study these regulatory sandboxes are increasingly observing that adopting such a sandbox is often more of a branding exercise than anything else, communicating like, hey, we're a country that loves innovation. And frankly, as more and more countries adopt sandboxes, that branding is delivering diminishing marginal returns. What seems to be more important in terms of promoting private sector innovation is the bespoke guidance that's offered to individual innovators that approach the regulator for assistance. But this doesn't have to be done through a sandbox. The CFTC and the SEC, for example, have formalized this type of introduction through their Lab CFTC and FinHub programs respectively. So they literally go around the country and have office hours with innovators to talk to them about how to create innovations that sort of can work within the regulatory system. And this is something that I was actually thinking about a lot when Gus was speaking about sort of the toxic mindset as between regulators and the regulated entity. It's sort of on a new plane when you're dealing with the clash of cultures between tech people and financial regulators, because there's just this presumption in the financial world that everything is regulated. It's just sort of an expectation. And then you have the tech people who just can't imagine that everything would be regulated. And it's sort of, these programs are trying to bridge some of that gap. The OCC has kind of forged its own path. It's proposed a bespoke national fintech charter. So this would be a non-banking charter for firms that want to offer financial services. And the greatest benefit is that if it comes from the OCC, which is a national regulator, it would preempt all of the other state laws that the fintech firms otherwise would have to comply with. Because of this preemption, the OCC's fintech charter is mired in litigation with the state authorities, so no one's quite sure how this is going to pan out yet. The CFPB's regulatory sandbox that I mentioned earlier is also haunted by the prospect of litigation from state authorities, so that limits its utility to some extent as well. The OCC's also recently announced an innovation pilot program that will provide guidance to regulated banks wishing to bring a new fintech product to market. And all of the agencies I've mentioned, the FCA, the CFPB, the SEC, the CFTC, and the OCC are also all members of the Global Financial Innovation Network. So that's a forum to promote sort of global discussion about the best ways to regulate fintech innovation. Oh boy, 5 minutes. All right, I'm going to go very fast. Okay, so what I noticed from these programs is that most of the high-profile experimentation that we've seen since the rise of fintech is designed to encourage private sector innovation. But private sector innovation can only do so much for the regulatory goals of the financial regulators. So it can promote competition and efficiency, absolutely, but it's really unrealistic to expect it to advance financial stability. That is a public good that private firms lack the incentives as well as the coordination abilities they need to promote. It also, I don't see private sector innovation as acting to protect the interests of investors and consumers. It can benefit them, but benefit and protection are not the same. You could see a situation where a marketplace loan was granted that a customer was very happy to have, but if it was provided to them at an interest rate that they're unable to repay, then they're going to get into problems. So if we can't expect the private sector to address the financial stability, consumer and investor protection implications of fintech on its own, how can regulatory experimentation help? Well, there are some mechanisms built into the investor-facing programs that I've already talked about that can seek to mitigate harm to consumers and investors. There are some, for example, fallback consumer protection provisions in most regulatory sandboxes. Also, as regulators learn about new technologies in their interactions with innovators, they will be better prepared to discharge their core regulatory functions. And ideally, these kind of collaborations could be a vehicle for new governance or the we think that Gus mentioned between industry and regulators. However, these are really incidental benefits rather than the primary goals of such programs. And the programs themselves are very resource intensive. Also, and this is very important, all of these investor-facing programs that I've spoken about are elective, meaning that only the fraction of fintech businesses that choose to participate in them are covered by them. So the regulatory experimentation we've seen so far in the fintech side is sort of lacking, I think. What I argue, my central thesis of the paper, is that we need to see more experimentation by the regulators themselves rather than facilitating private sector innovation. Which brings me to SupTech. So you may have heard the term RegTech.
I thought it was SupTech.
It could be SupTech.
Yeah. Well, because supervision.
Yeah, but maybe it's my accent. I don't know. Okay, I'll use SupTech as deference to Tom. So you may have heard the term RegTech, but RegTech is a confusing term because RegTech refers not only to what regulators themselves are doing, but also what the industry is doing in order to cope with regulation. So tech solutions for compliance and things like that. So I don't like that term in this context. I like SupTech, which refers only to the use of technology by regulators. So again, I've got a largely descriptive section of the paper that talks about the present state of SupTech. This relies very heavily on work done by the Bank of International Settlements. They survey regulators from the most developed economies to talk about, what are you doing? They found that most of the SupTech experimentation has been in the areas of AML, KYC, reporting obligations, and fraud detection. They found very little experimentation with regards to prudential regulation, and that would be really highly relevant if we were concerned about financial stability. The experience in the US supports the BIS's conclusions. There's very little innovation available regarding SupTech innovation by the OCC, who is a prudential regulator. Experimentation by the SEC and CFTC has been much more visible with regards to their reporting and surveillance functions in line with what the BIS has found. The CFPB hasn't really been trumpeting any SupTech innovation, but it's interesting because the agency was only founded in 2010. It always sort of prided itself on its regulatory savviness, but it's in a state of flux. This is a nice way to put it, since the Trump administration started. So, yeah, I don't think we can take too much away from the CFPB not talking about SupTech innovation. So my analysis of the current state of SupTech is that it's primarily occurring in the easy cases, places where regulatory objectives are not conflicting. It also appears to be being used to respond to industry-driven RegTech innovations. But what we don't appear to be seeing is any SupTech experimentation to address the new threats to financial stability, consumer and investor protection that I've highlighted at the beginning of this presentation. So in other words, I've made the case for circuit breakers for smart contracts, for bespoke data sets to be provided to machine learning algorithm developers to ensure that machine learning has some ideas about tail events that could be problematic for financial stability. Dan Schwartz at Minnesota has done some work on using data sets to debias algorithms. So I'm sort of out of time here, but I think there's just a couple of things I want to mention before I go. Because these types of regulatory experimentation, things like circuit breakers and new data sets, they have to be plugged into private sector products in order to be effective. So really, they need to be developed sort of in tandem with the private sector technology to have any efficacy. So time is essentially of the essence if these regulatory strategies are going to work. But to bring us full circle, SupTech regulatory strategies, they take the form of technological innovations, but they are still regulation, and they face the perennial problems of any regulation trying to deal with a new sort of technological space. Limited resources, arbitrage, conflicting mandates, etc. So the paper concludes by engaging with these limitations. I am not fatalistic. I don't think we should throw up our hands and say too hard. I think we should try, even though a lot of humility is needed about how successful these types of strategies will be. So thank you very much.
It's a pleasure to comment on Hillary's work, and I just want to pause for a minute to say, let's enjoy the room. This is the first big sort of public thing we've done in this room, and it really came out pretty nice. So thank you to the So as Hillary's work on stability reflects, once she gets into a subject, she stays there for a while and really digs deep. So in the spirit of that, my comments today are more directed at the larger project than at the specific paper. And I want to start by a couple of caveats about my capacity to give useful comments. The first is I'm an insurance guy, which means I know a lot more about the decidedly low-tech, state-based insurance regulatory system than about the federal regulators that are pioneering more high-tech approaches, such as the SEC and the CFTC. And the second and more relevant limit is that despite having taught a seminar on fintech for the last 4 years, or maybe because of it, I'm starting to have doubts about the utility of fintech as a useful general category for two reasons. On the one hand, many of the commonalities of fintech, automation, data science, the VC funding model, online distribution, are not unique to fintech. And so focusing too much on the fin in fintech can lead us to forget that these commonalities simply represent the appearance in the financial services sector of broader technological developments. So that's, on the other hand, focusing too much on the tech in fintech risks ignoring the very different histories, markets, regulatory frameworks, and other institutional features of different kinds of financial services. There are some fintech innovations that are taking place in multiple financial services markets that do present common challenges, and my research on robo-advisors argues that automated financial decision tools are one example of that. But I increasingly think that the differences between Betterment, the investment advisor, the insurance startup Lemonade, the P2P lender SoFi, the payment innovator Venmo, and different cryptocurrencies, that the differences between these are more important than their similarities. And also because tech makes us think of Silicon Valley disruptors and not incumbents, it can lead us to not see how important incumbents are in the financial services market. And again, going back to robo-advisors, which I know the most about, the biggest market share in the robo-advice space is Vanguard, Schwab. These are incumbents. It might be that startup disruptors that sort of motivated them, but incumbents are important. And so where I'm coming out about fintech is that the Goldilocks approach, I tell my grad, not too hot, not too cold, but just right. Not too much fin, not too much tech, but the right amount, is to think about the encounter between these broader technological developments and the financial services market is as case studies that are broadly useful because the comparatively highly regulated nature of financial services markets means that there's greater opportunities to get under the hood, to see what's happening, and because there are regulatory agencies that have jurisdiction, maybe not yet statutory authority, but jurisdiction, who might be willing to do something in relation to the coordination, collective action, problems or other things that we find in the case studies. And then, to be really Pollyannish, and to think we might study the effectiveness of what the financial services regulatory agencies do about these problems in the fintech area might help us in the broader tech. So that, maybe Pollyannish. So which bucket does Hillary Allen's thing fit? Is it not too fin, not too tech, or is it fintech? So stay tuned. So what I'm going to say, the things I liked about the project are she's thinking about financial services regulation in terms of experimentation, which I think is the right thing. And so she's got so in the paper there's a nice taxonomy of experimental government, taxonomy of the types of experimental government programs that are addressing fintech. Innovation hubs, regulatory sandboxes, special charters. And then the second thing I like about it is she's collecting examples of ways that the technological developments, the broader technological developments, pose identifiable risks to specific financial services. There's not generalities, but identifiable risks to specific financial services. And she's coming up cataloging specific things that regulatory agencies could do. And here my favorite example of this is the one that she mentioned here, is that the automation of the collateral posting procedures under swap contracts. Personally, I refuse to use the term smart contract because they are not smart and they might not even be contracts. So automated scripts. But as Hillary says, that automated collateral posting requirements could lead to massive liquidity problems in certain markets. And so I really like the suggestion, and I think this, I don't know where it's from, but of requiring such programs to include a reference to oracles. You gotta love they like that. An oracle is just a place you go to get information, that the smart contract goes to get information. So that basically would allow the automated collateral posting procedure to have a switch that the regulator could turn off.
That's not a reference to anything. I came up with that.
Okay, good. So to have a switch that would turn it off, which seems to me incredibly plausible, so I like, so specific things, problems, so I like that. The other thing I like, another thing, is that she's beginning a catalog of government programs that adopt the technology that's powering fintech. In other words, she's not just saying, okay, hey, what's the automated stuff that's happening in fintech, but how can those same broader technological developments, data sciences, automation, so forth, be used by government to adopt regulatory functions. And I really liked SoupTech, which I think SoupTech, because it stands for supervision, it pulls up the idea of supervision. And Hillary's totally right that the term RegTech has been captured by private vendors at self-compliance programs. And also, there's nothing particularly financial servicey about the term RegTech. It could be an environmental compliance program. It could be something that complies with the Federal Aviation Association. So whereas the concept of supervision is a concept that's principally a financial services sector. So if it seems to me that SoupTech is more likely to retain the meaning that Hillary's giving it. All right, so those are things I liked. What I would like to see more of in the project, not so much the paper, is I'd like to see some analysis of the comparative advantages of these different, or I'd like to see more, because this is I'd like to see more analysis of the comparative advantages of these different experimental programs in teaching regulators about the new technology. Because if part of the problem is the race how do these programs teach regulators to more about? The second thing I'd like, and this is really for this paper, I think it should be more clear than it appears that the link between the fintech developments that you're talking about and SoupTech is really the technology, because SoupTech is, so far anyway, not doing things that are really about fintech. It's, KYC, for those of you who aren't, financial services, means know your customer. AML is anti-money laundering. These are problems that Chase, JP Morgan, so this is not about about the startups. And so what SoupTech is doing so far anyway is addressing sort of the common problems that the regulators have in supervising the incumbents. And that I think for the near future, the market sector, the market share of the consumer-facing fintech sector is too small to justify special regulatory tools for that. And then the final thing I would like is a lot more detail about the existing SoupTech so that we readers can get a report from Hillary, who's going to learn all this and tell us, develop a better understanding of exactly what it is that agencies are doing and how, so that to disseminate knowledge to me and others of the technical capacities and existing applications of SoupTech, to promote a kind of crowdsourcing of ideas around how could those existing capacities be applied to other problems, and then also to develop ideas about how to extend the existing capacities. So, in sum, it's not too much fin, it's not too much tech. I want more, but I think the direction is just right.
Quickly. Thank you for those kind comments. I spend a lot of time with the three bears too. I have a 1-year-old and a 3-year-old, so I will report back to Charlie that it was just right. So thank you for all that commentary. You're right that once I pick up on something, I don't let it go. So you will be unsurprised to hear that I'm writing a book. So this is enormously helpful for that. I agree with almost everything you said. I don't think fintech is a particularly useful term, and I do think that incumbents are critical because, as you say, like the bit players right now are not really the problem, especially if you're concerned about systemic risk. What we really need to be concerned about are the technologies being used by the incumbents, and I'm actually, for that reason, organizing the book not around particular business models per se, but around the risk management, capital formation, and payments transfer functions of the financial system, no matter who is discharging them. So I like your point about discussing the comparative advantages of different experimental programs and learning about the new technologies. Part of the issue may be that that information is just not available yet. I mean, SoupTech's really exploded in 2019. We're talking in sort of very new territory here, but to the extent that that's feasible, I'd like to. I also like the point that you made about linking the fact that the SoupTech that I'm promoting as opposed to the SoupTech that is already occurring is the SoupTech that uses the fintech. So I'm going to work on that. So in terms of getting into more detail on the SoupTech, you mentioned sort of crowdsourcing and international collaboration on that. I think there's definitely scope for that, and it's already started, but I do think there's also some perils that I'm going to have to explore. One is if we're worried about correlation and we have all of the regulatory agencies around the world agreeing on a particular regulatory strategy, well, that's a lot of correlation too. So it doesn't mean we shouldn't do it, but we need to tease that out. Another thing which I've explored, not in this paper, but I've started to explore in other contexts, is just when you have these strategies, regulatory strategies designed to encourage private sector innovation, does that put that regulator in an unusual place when they talk to their international counterparts? Because now are they worried about giving up trade secrets that might disadvantage their regulators as opposed to regulators in other countries? And I think maybe that's not new, but to me that seems like something new. So I think that's something that's got to be thought about here. It's sort of a new capacity for regulators. So lots of food for thought. We'll definitely go into the book, and thank you so much.
All right, we'll open it up for questions, but I'll take the first one. And so as SoupTech gets up and running and regulatory agencies begin to invest in new technological approaches, either to learning about what they're dealing with or to wargaming, things like that, has your research suggested that they're making that technology, or are they buying it? In other words, are they working with partners in the private sector to develop those technological capacities? And which do you think is more promising?
So from what I understand, and really I'm drawing all of my knowledge from the BIS's survey here, it's a little column A, a little column B. So basically, I think a lot of the regulators do not have the expertise in-house to do it, so they would like to outsource it. But in fact, there's not that many third-party vendors who are out there doing this stuff because it's such a niche market to do SupTech. And so Luke Enriquez at Oxford has made some interesting points. Well, if you use the same vendor for both SupTech and RegTech for the industry, that vendor is going to be potentially undermining the SupTech in order to favor their compliance tech clients. So that adds an interesting wrinkle in all of this. So as far as I can see, the best way forward, and I think there's lots of different ways and it'll depend on the individual problem, but just sort of as a general rule of thumb, I think the best way forward is for collaboration between regulatory agencies and academic institutions, seems to be, and that is happening. I think you sort of have the incentives right, the manpower right, so I think hopefully there will be more of that going forward.
Questions from the audience? Yes.
What about the credit unions?
Can you press the button on your mic?
I would like to know more about the community development institutions to help develop new housing and housing innovation, and how we're going to do away or eliminate the mortgage industry. How are we going to change that program?
So I don't think, well, so in terms of what fintech is out there to deal with the mortgage industry, there isn't much actually. So the marketplace lenders that are out there that are trying to sort of take this space are typically doing unsecured loans, not the mortgages. And so the incumbents are still there doing the mortgages, and I think they'll use some of this technology, but I can't see them being done away with by any tech.
But, I mean, again, is the glass half full or half empty? One of the promises of these technological developments is allowing people to be able to borrow money who can't because they don't have a credit score. And so there's sort of alternative measures of credit worthiness that, and so for instance, the CFPB did do a no action letter for, not for a mortgage, but for a lender to be able to try new forms of credit worthiness measuring, and then Dan Kwan left the CFPB, and my insight into what they're doing disappeared. But there is, I do that for the sort of unbanked or the uncredit scored, there is some. That's the glass half full. The glass half empty is that this could be just another way to do predatory lending.
That's sort of, I have a lot of skepticism about
Right.
these new
And,
systems.
and there has to be a new way to innovate around the banking system so that we can secure the properties.
I mean, I really just, as much as, tech was all about disruption, I don't think it's really going to be disrupting the financial industry as established anytime soon. There's just the incumbent players are very powerful. The fact that it is such a highly regulated regime actually makes it hard for new people to step in, and that was sort of part of the story about the regulatory sandboxes. We need to allow non-incumbents to come through, but in fact what we see happening is more and more it's just partnerships between tech firms and regulated banks, or if you do have a startup that does a really good job, the incumbent institutions acquire it. So I think the disruption in the financial industry is not coming anytime soon, unfortunately.
Or fortunately.
Or fortunately, yeah, you're right. In response to your question. Maybe.
Other questions from the audience? Yes, right.
I'm trying to think of a way to say this in a way that's not cynical, but
Just
I can't
go for
think of one. Pick your favorite regulatory constraint. We can pick anti-redlining. We can pick know your customers, anti-money laundering. Pick anything. There's a certain amount of liability a financial institution might have, and then they can escape it if they do something that makes it look like they're serious about it. And why shouldn't I believe that this is mainly just cartel formation by the regulator as opposed to actually solving the problem?
You sound like
So So one of the themes of my FinTech course is that there's a life cycle to the relationship between a new company and regulation that you didn't need me to say, which is you come in and regulatory concerns are reason number 553 why you might fail. So you ignore them. And then you get big enough, and then all of a sudden you become joined at the hip with the regulator, and between the two of you, you stamp out all your competition because, of course, they shouldn't be allowed to break things the way that you broke them when you...
Couldn't have put it better myself.
Well, and it's actually already playing out with the marketplace lending firms. So the OCC has come out and proposed this FinTech charter, and it's actually quite onerous to comply with, right? It's not fully as onerous as a regular bank regulation, but it's pretty onerous. And so one of the big questions was, well, who would even want this thing? Because it's got a lot of onerous regulation. And it turned out that the people who are most likely to want it are the most sophisticated of the marketplace lending firms, the most established, who want it to keep, they can get it, and then that will sort of make it harder for future marketplace lending firms to come up. So I don't disagree with you on any of this. I mean, I think that's right, but yeah.
But there's some innovation, so, I mean, it's just a more constrained innovation than it. So there's a company called Payoneer, which is a payment service, and when they came in, they broke all the rules. That's how they got. And then we knew that when they were established, because who did they hire as their general counsel? The former assistant general counsel from MasterCard. But on the other hand, before, that nothing like Payoneer ever existed before, and they helped create a new way of they were the company that came up with the idea of that you could preload debit cards, and that would be a way to pay an Etsy worker in Taiwan, or the way that Airbnb Airbnb uses them to pay their hosts in different countries.
I mean, one way to think about it is perhaps if there is going to be a regulatory moat that's valuable, one of the functions of having these office hours and FinTech innovation hubs and things like that is to create at least a little bit of competition for the regulatory moat. So they may end up keeping their competitors out, but at least they're competing for the opportunity to do so in the first instance. I don't know if that's more cynical or less cynical. Chuck. Yeah.
Well, listening to the comments about the incumbent financial services industry and how difficult it is to break through, and the cynicism, which is easy to acquire. Recently, as I was looking through some of the industry defenses of why the incumbents have what they have and have to keep these monopolistic infrastructures because, this is efficiency. It's amazing how similar those are to what we heard from Ma Bell when I was a kid. Oh, how could we have more than one phone company? I mean, that would just be a nightmare. Can you imagine that? So it might be worth going back and sort of rethinking the financial services in the context of where this discussion started this morning.
So
maybe there's some lessons there.
Yeah, I mean, I think that you can talk about financial regulation in two different realms. There's the realm of the ideal and the realm of the possible, and I toggle between the two effectively. And this sort of paper is sort of like, here's what we've got on the ground, here's what regulators can do around the edges. Is that by any means the best regulatory solution to our financial system as a whole? No. I mean, I think smaller banks would be good. I think completely rationalizing our regulatory architecture to the Twin Peaks model would be good. And these are things that just have no chance of going anywhere until after the next financial crisis, coming soon to a theater near you. So, maybe there will be support, but right now, I'm sort of, I'm tinkering around the, and that was the big criticism of Dodd-Frank as well, that it sort of tinkered around the edges rather than doing wholesale change. And, when you can't do wholesale change, I still think it's worthwhile to tinker as best as possible, understanding, of course, that tinkering is more complicated, creates more opportunities for arbitrage, can have more unintended consequences and therefore is not the ideal way to go about things, but we don't live in an ideal world.
Don't give up.
Keep fighting the good fight.
Tom?
So you brought up the idea of machine learning and using it for supervising measures. So when you talk about machine learning, there are two elements. There's the software element and there's the data element. And I was wondering if you were thinking about the interaction between them. And there could be a few situations. I'll mention one or two. For instance, if you're setting up a sandbox and you're running a certain program on proprietary data of one regulator, and then that entity turns around, the tech entity turns around and uses it with another regulator in a different country. So there are various issues here. The algorithm has changed, so maybe there are benefits to the tech company because of the data itself. Also, if you could look carefully at the algorithm, you could figure out what the data was. So you could have this issue in variations, right? You could have it that they use this algorithm in a reg tech with a company, then they move it to the regulator, you move from the regulator to the regulated, or an international world. So I just want to point out that when you think about machine learning, you should think about the data and the tech separately.
Yeah, no, I think that's right. So in terms of the soup tech that's being done now, I think the regulators are engaging with both the software and the data. And I think you are absolutely right that there are interesting questions raised about sort of reverse engineering here. As I mentioned, Luca Enriquez has done some interesting work on that being a new source of regulatory arbitrage. And I think, it sort of throws international coordination for a loop. In terms of what I'm actually proposing, it's less about the software and just about the data, because what I'm suggesting, so I'm not anti what the regulators are doing now, but what I think I would like to see that I notice is missing is that particularly when we're talking about financial stability, a lot of these machine learning algorithms are not being exposed to any data that reflects low probability, high consequence tail events. So I talk about sort of the development of potential hypothetical scenarios to fill that gap. So really, to the extent I'm saying anything novel, it's focusing just on the data itself. But in terms of what is currently being done, it is a combination of both the software and the data.
Other questions from the audience?
You've stunned them into silence.
Well, I'd like to ask about something you brought up in the paper. I missed. Yeah.
So I'm fascinated by the discretion involved in sandboxes. And there was an experiment about this in telecom regulation where the agency unilaterally asserted an authority to do it and was overruled by the Supreme Court. And so they created a statutory framework where it's just now subject to a form of substantive standards and arbitrary and capricious review. And I find myself wondering, believing your argument in favor of experimentation, but worrying about legality, but also assuming we can solve that, policy. Is there anything meaningful we can say about how to guide the scope of that?
So if we talk about sandboxes in particular, one of the things that I found frustrating when I first started working on this is just how little publicly available information you could get from the FCA about their process of deciding, what they would take into account. When they didn't talk about when people could be ejected from the sandbox, none of that stuff was made publicly available. And I sort of, managed to occasionally have conversations with people here and there, but it shouldn't take that, right? There should be more, I think, transparency about what is actually involved. And I guess the flip side of that is by not having that kind of stuff out there, they could be very nimble in terms of constantly tweaking it as they went on, which is, I think, something they pride themselves on. So that was, so that's the situation in the UK. I'm not an expert in UK administrative law, so I don't know if there were hoops they had to jump through to get that level of discretion or not. In the United States, I think it would be a more complicated situation. As I said, we don't really have a federal sandbox except for the CFPBs, which was recently proposed and is, I think no one's really applying to use it because they know that the state regulators are going to sue the crap out of it. So, you know, I don't know if we've even gotten to there yet. So, yeah, there's questions about legality. I mean, I think, and you and I discussed this earlier today, I think with all of this experimentation, there needs to be a certain sense of humility that some of it will fail. And I don't know how you reconcile that with a legal system that wants infallibility from its regulators and punishes them accordingly. So this isn't just a question for fintech regulation. This is a question for regulation of innovation in general. If the technologies themselves sometimes fail, we shouldn't expect the regulators, you know, who are following that technology to be infallible. But yet we do, and that causes the hesitancy, I think, that you see with a lot of experimentation. And that is going to be a problem for interests like financial stability and consumer protection that really have no one to promote them other than regulators. So I don't know what we do about that other than, again, keep tinkering around the edges, keep trying.
So I want to delve into one of the substantive risks that you identify in the paper, which I think is most acute given the rise of robo-advisors, and that's the idea of hyper-switching. So that you could have correlated changes in asset allocation or in investment strategies. And I'm going to just say, hyper-switching sounds great to me. If people aren't providing a good deal or doing a good job, allocating assets, they should be put out of business by my digital assistant who places me in a better loan tomorrow, rather than staying in sticky relationships with banks that have my customer information and it's hard to leave. Is that framing just totally naive in how to think about that? Why should I worry from a financial stability perspective?
Well, I think, so the hyper-switching term I'm not sure is entirely apt. I mean, I know Rory Van Loo's done a lot of stuff on the hyper-switching with the assistants, but the example you gave is like switching from a loan with Bank A to a loan with Bank B. I'm talking about the customer does nothing. They stay with their robo-advisory firm. Their robo-advisor decides through some machine learning process that today is the day that everyone who has a portfolio based on this algorithm will dump their assets. So in fact, there's nothing that the person does except continue to have their funds invested with this particular robo-advisory firm or an incumbent firm, much bigger incumbent firm that uses this kind of technology, which is where the real risk is. And so they do nothing. They don't switch anything. But all the assets get dumped, and suddenly the price of those assets goes down, and then the financial institutions that are exposed to those assets that have high leverage ratios then have to sell off other assets, and then the price of those assets goes down, and then you have a vicious cycle, and then we end up in a financial collapse.
Yeah. So in other words, it's a fire sale risk that then might trigger capital calls and things like that. And that's what we would need to war game.
Yeah.
Got it.
I specialize in worst case scenarios. Apparently I'm a delight to be married to.
All right, I think that we have come to time, and we will take a 2-minute break to switch over
No hyper switch.
No hyper switching, some peaceful switching, and we'll thank Hillary Allen and Tom Baker for